Good afternoon, good morning, depending on what part of the coast you're on here. Welcome to McQueen Financial Advisors January Economic Update. We're excited to have you here with us today. We've got a lot of great things coming up and a lot of great discussions, and also today is a Fed Day. I'm Charlie McQueen, President of McQueen Financial. Thank you again for joining us. Today we also have with me today Craig Cecilia, our Chief Investment Officer and Head of our Investment Advisory business. Craig just came running in the office full speed here from his office as we had the Fed meeting today. So we're really excited to hear what the input from the Fed and what happened. As expectation would be, we'd expect they'd be leaving rates unchanged and a very accommodative stance given the world that we're in today. So thank you, Craig, for joining us.
Thank you.
So today, it's an administrative process. If anyone has any questions, please feel free to submit that at any time. The questions pop up, we'll answer them if it makes sense along the way, or we'll answer them at the end of the presentation. The webinar today will be recorded. If any of your team members would like it, your team members, please reach out to your MFA advisor and they will get you a copy of this presentation. So with that, we got a whole bunch of stuff to talk about here, and we're just going to hop right into the graphs. And today, really to start off, the economy and pretty much everything that's happening continues for now the past 10 months. Hard to believe, 9 months with COVID. And I look back to our initial presentation we did in the economy with COVID and what's happening there, and it's been a interesting up and down process that's taken place through this entire stuff. And COVID continues to be the biggest concern. I think it's going to be part of the best and the worst part of the economy. And kicking it off here, this graph here really is looking at the estimated number of infections. Now, this is one of the premier sites that people use for data, and this is showing history from August through today, then predicted forward to May. And a lot of the graphs are really starting to show that things are coming down quite dramatically, and the number of infections is going to decline quickly till May, where we hit effectively zero. Daily deaths. Here, if we wear masks or we don't wear masks, if we ease things, it's going to take a bit longer is what this is projecting, but if we continue to wear masks, it's showing effectively by May we're down to nearly the zero number. It's an interesting analysis. These graphs have been wrong since the beginning. This one is hospital utilization, and the graphs continually have predicted higher than where we've ever gone. In some instances, in other instances, we weren't been high enough. But this does also show that May we run into zero. And actually looking at these numbers, I think most hospitals would probably go bankrupt with lack of utilization of their ICU beds. But the graphs are really pointing this, and this is a bit of what the stock market is looking at, is that COVID may be coming to a close sooner than later. Unfortunately, I don't put a ton of belief into this chart from a standpoint of timing, as I've tried myself to get scheduled to get the shot, and I'm not seeing that I will be able to get the shot till much later. And the reason being is that fortunately healthy and not old enough to be in the early groups, fortunately. But I'm not seeing that I'm able to get a shot till May, June, or July. And so I think these graphs might be a little bit optimistic, but it does give the viewpoint that there is life after COVID. And a lot of what we read today is 2021, 2022, is this the 20s all over again? The roaring 20s after the pandemic in 18, and here we are, pandemic in 20 with the roaring 20s into 21, 22. One would expect there's a lot of pent-up demand and we'll see things move forward. So COVID is going to have a lot of components with this. And if we look at the recovery here, we're still forecasting our K-shaped recovery. And what we mean by the K-shaped recovery, everyone else is on the top half where things are going better, and people in the bottom half are the ones that things are not going well. And that continues to be some of the areas that obviously are significantly impacted. Travel, restaurants, convention centers, hotels, resorts, transportation, not many Uber rides going on right now and not many flights going on right now. And so all that area is really struggling, and we expect it to continue to struggle. And so this is a tale of two separate outcomes. And as we spent a bit of time talking about this, we really have this dichotomy that's come to play, and we have people that are capable of doing remote work. A credit analyst, an analyst, someone in the technology space, call center employees. This type of work can be done remotely is really doing well, and this is part of why we're seeing such good things in the economy. Costs are down substantially for those people. They don't have to drive to work. They're saving money on gas. Costs are down. You're not buying work clothes. As we laugh this day and age, a T-shirt and a sweatshirt probably constitute, with shorts, standard office environment wear. Some people have stopped shaving effectively too, and those are some things that we're seeing happen here. Yes.
All right, so I take personal offense to that shaving comment there, Charlie.
You should.
But there's other effects that take place on this, and it's more of a reallocation of resources. So if we're not spending, or even households aren't spending as much on, say, work clothes and stuff, it's shifting some buying patterns into some discretionary items, some more electronics or some other pleasure items that people would normally say, I can't afford it, I don't have the time to use it. And there is a big shift on what spending patterns are in households.
I love the foreshadowing in that statement. It's absolutely wonderful, too, because we're going to talk about that. And it goes right down the comments here of free time is up. So if I'm not driving to work, and if I'm going to be able to sleep in a little longer, do some activity, or I'm home at 5:01 versus a 30 or 40-minute commute, free time is higher. People have more free time. And what you said is engaging in other activities, which I think is going to be a positive viewpoint for a lot of us on the call here for the next few years. And then also with this group specifically, their income is unchanged. Now, arguably, one would say, I'm not going to Disney this year, so my income is up by $3,000. And so there's some ways to look at it, that travel to a degree and activities are down, so people are home and doing more outdoor activities. And so there's a lot of changes that are taking place here. And I do think one of the things, actually, Craig, you and I discussed earlier today, which is business travel. When does business travel come back to full speed? And I question if business travel ever comes back to the degree that it was before. And this is definitely going to change some free time activities on a go-forward basis. Now, for those that are not able to be remote, and I look at restaurants and travel and hotel, and you could talk about any sort of retail sales, these are not doing well. Effectively, there's no income, and the jobs are gone. There's no other similar jobs available. People don't have the ability to go buy or go get another job at another restaurant, because here in Michigan alone, they predicted that 3,000 restaurants have failed in the past 9 months, and it's going to be similar in every state.
Right, and this is one of the things that we do appreciate, actually, about what's taking place in the prior as well as the current administration in Congress, of trying to have targeted stimulus towards areas that really do need that to help them get through, because there is that, like you mentioned, the K recovery, and there's that needed and targeted stimulus that's going to come their way, which is absolutely fantastic. Yeah,
there's some good stimulus coming in, and that that does tie into. I do hear a lot of conversations about a economy that's going in two directions, have and have-nots, and the widening wealth gaps. And although if you're following Reddit, there might not be as much as a widening wealth gap with everyone investing in stocks to blow up short sellers and make a lot of money. That could be modifying things here today. But there is a lot that the government has done, and here they've done a lot with unemployment benefits. Now, unemployment benefits were paying $65,000 a year. We're now down to roughly $45,000 a year for 39 weeks, so 10 months. There was an executive order that was passed saying if you're fearful of getting coronavirus in your job, that's okay to leave and you can still get unemployment. So those that are not working and those that are in jobs that are completely closed, they are getting fairly good compensation. Again, not everyone, it's not perfectly equal, but unemployment benefits are not taxed, is my understanding. And someone had told me the other day that the benefits are as if you would actually make the taxable amount above this, so the amount you pay in taxes. So it comes to some significant income going out to people. So it is there. I know there's a lot of conversations right now about where people are in this splitting of the economy and wealth gap, and there definitely is a wealth gap from the stock market being as strong as it is, but our social network is really in place, and arguably one may say the social network is a little strong. Now, over a quarantine of a few days of a COVID scare I had this last weekend, my daughter and I were locked in for a number of days waiting on test results, and believe it or not, she had a common cold, which is scary that a 6-year-old would have a common cold, right? Very normal. But we did stop at McDonald's, Father of the Year, getting some good food, and the McDonald's we stopped at was in Boyne City, Michigan, and help wanted signs at $15 an hour up to $20 an hour. A lot of places are struggling to get enough money in, and there are not enough people in to work. And so they are paying fairly well. So another thing that's happening with this lockdown, we talk about the income gap and activities, and this is actually an interesting activity for financial institutions to really think carefully about, and we'll talk about the broker in the lobby later to foreshadow that. In the second quarter of 2020 alone, not first quarter, I apologize, it's the second quarter of 2020 alone, over 170% increase in accounts at Robinhood, E-Trade, and Charles Schwab. And going back to all the Reddit post people buying things today, they've actually been putting some curbs in today, but amazing client growth of people spending money and getting into the stock market.
And all guaranteed to make money, too.
Absolutely. Just don't be the last one out.
Right.
So, but definitely a lot of things happening in that area growing. So speaking of the stock market, it, as Craig mentioned, it only goes up effectively. This is going back from 2007 with the things that we fell out in the terrible time we had in 2008 and 9, and then the march upward and until the coronavirus hit in the beginning of 2020, where we dropped down substantially in a few days, and then the skyrocketing march straight back up. So definitely amazing moves in the stock market, lots of wealth creation. And actually, this has been fairly helpful for state governments. A lot of state governments keep talking about how they're in trouble and they're having monetary problems, although they are revisiting and keep showing that their budgets are much better than they expected. This is helping some of their pension liabilities right now, too, substantially.
Yeah, definite improvements, and we were having a little bit of worries in that whole market from a credit perspective of what would be the total shift in their liabilities, unfunded and whatnot, as we were going through the pandemic. But they've come out fairly well thus far. So a lot of them are only on annual financials. So we did see a lot of schools that have June financials, which we did capture some. But it'll be probably next year's financials where we can really see if the trend is going the right way and from a credit strength perspective.
Yeah, so I think beginning things I'm seeing are good. What one will ask, and I know, so we'll preempt this question that'll come in, is the stock market going to keep going up? And the answer is clearly yes. Now, somewhere along the way, it may come down a little bit first. We are definitely, all kidding aside, at very, very high valuations. Things do look fairly lofty. But we'll talk a little bit about cash and what happens when there's so much cash in a system. And so I do think that the stock market has some positive potential to it. And also it relates to what happens when everyone gets shots, or a vast majority of people get shots. How many people return to buying things, going to stores, and spending the extra money that you all see saved up in people's checking accounts and money market accounts today. Just to stop into, it's good to see that bank stocks have recovered. We fell off the cliff, again, with the beginning of the coronavirus in 2020, and only recently have we recovered from those. But it is also interesting to see bank stocks and financial stocks are still have not recovered to the Great Recession, 2007, 2008 recession there. So we're slowly getting back there, but we're not quite there yet. So one of the biggest conversations we have today is housing, and this to me is a really interesting activity. Housing is not necessarily an investment. Some people may look at an investment, but it's a spot to live in, a house and a home. And I think more often now than in the past, when people realize that you have kids at home homeschooling and you have parents home working, and you have the rest of the people running around the house making noise while you're on conference calls, or my daughter crawling on the floor, which many of you may have seen so far. All those neat things, but what we've also seen is people, while they're looking to improve their home or change or get another home office, we are seeing a record amount of time that people are in their homes. we're now looking at 25% of Americans have been in their homes for more than 20 years. Truly amazing numbers. And so this to me does show that there's going to be a decent capability of homes continuing to do well and continue to grow, because also there was a lack of homes built for a long time. Now, home price indexes are obviously up. If you go back from 2001 to 2020, it's been a nice gain, but one must think if we went from 100 to 200 nationally over 20 years, you know, we're not that high of a percentage increase year over year, especially compared to the stock market.
Yeah, if you have to kind of smooth it out. And it was interesting, as of a very recent this week, the home price index that came out is the year over year was approximately 9%, which is a big increase. And Charlie, I do agree with you on respect to home prices and where we are in that marketplace of the cycle. With the accommodative lending environment we're still in, we do expect interest rates to be low for quite some time. We'll talk about it at the end of the presentation. We expect the housing market to still continue to be one of the shining stars of the economy right now. Now, it is being muted with some other, negative things taking place in the economy, but the housing should continue to do well.
I think that's a fair point, and one of the reasons you put there, well, is we also had this massive underbuilding of homes, and this shouldn't be a surprise to anyone on the call here today. We've talked about this several times. There were not enough homes built. Now, there probably obviously was an oversupply coming into this. We were closer to 2 million homes being built on an annualized basis at the high point in 2003-04. But we stayed down at the 400,000 new homes. Remember, the population of this country increases by about 1% a year, which is 3.2 million. I think that 50% of people buy homes effectively, or two people get married and buy a home. So that's 1.5 million, 1.7 million type homes a year. And we underbuilt, and now we're starting to see that demand again, especially with people being stuck in homes. They're really looking to change and move things around. And also a bit of the modification of people moving from cities to rural areas. Now, add on top of this, great conversation. Richard, one of our great tech analysts here today, and I were debating this morning home values, and the interesting thing that we really focused on was the replacement cost. And if you're looking to buy a house today, the cost of lumber has skyrocketed substantially, so the value of existing homes has gone up also. Now, it may be a short-term phenomenon where there's a lot of problems right now with distribution, with COVID, but there's also a big growth function here. So I do expect this is going to continue. We should be building closer to 1 million to 1.3 million, 1.4 million homes a year, and even up from there. Are they in the right neighborhood? That's a whole nother conversation where there's population growth, but there's definitely demand for homes to be built for quite some time.
Right. It was underbuilt for, call it a decade. Yeah.
All right. So from there, employment. One of the big things here. This was a question that was asked to us last month on a webinar, the labor force participation rate, and we've spent a bit of time looking at this. Labor force participation rate did decline substantially when the coronavirus hit. We were actually doing quite well in the long-term basis. We were coming up. We do have a lot of components here that come into play. One is the retirement of baby boomers are happening at high levels. Two, millennials, well, there's a huge force of them coming through. They're only recently been coming into the workforce age. And you put those two components together, we're at this interesting spot where I expect the labor force participation rate to come back up here, but be probably in the 63% range for quite some time. And so we're going to be here for a while. We do need to come up a bit, but there is also this function of people retiring and what's happening, and then the new younger generation coming through. So we get a little bit of this pause time frame. And we do have to add in here the amount of unemployment. When unemployment is paying as well as it is quite difficult to compete with it, and that's going to cause some people not to be looking for work. So some interesting facts here, interesting things moving, but we're actually in a reasonable spot. Now, one thing here, as I mentioned earlier about McDonald's and seeing help wanted signs, we do see a number of help wanted signs around. We're out and about, the limited amount we are today. It's interesting here, involuntary job separations, 3.8%. Job openings, 4.4%. Job hires offers, 4.2%. we are actually at a really good spot when we start to compare these numbers. This shows that if you want a job, they're out there. It might not be the perfect job, but there's still a lot of demand for jobs right now.
Yeah, well said. As the skill set for the jobs that we're looking for is extremely important. And the only thing that I see that kind of almost a little bit of a warning for me is those involuntary job separations, that most recent little tick up. That's a little bit of a concern, but the job openings is key, and it's going to help us drive through the next few quarters as well for helping on that unemployment rate.
This also gives some idea of credence to the 2020, post-pandemic surge of the economy. That stuff could really get going well because, again, it appears that most people, again, it's not everyone, I know that, and it's not perfectly fair, but a lot of people have jobs and a lot of people are able to go forward, and this comes down to the unemployment rate. And looking here, United States of America, how many people would believe that 9 months into a pandemic that we would be at below 7% unemployment? I mean, just an amazingly low number, higher than we've been. If you look back where we hit in 2008-9 and where we've come down to, it's just been a great improvement. And the length of unemployment is going up, and I do think that relates a lot to the restaurants being closed, bowling alleys being closed, those types of activities.
Yeah, and I think we'll see the unemployment rate continue to trend down throughout the year as long as we continue to see the availability of the vaccinations and the increase. A good example is Johnson & Johnson in their final trial and what they want to get out. I think that's going to be a whole positive for our economy as we can get people, the workforce, back into the positions they're meant to be in.
And at the realm of getting into a political discussion, which will never end well for me, I enjoy this, but we looked at all the polls and all the polls that said who's going to win a presidential election, not, and all the debate around polls. I then see these things about all these people that don't want to get vaccinated in these polls, and I wonder who they're calling. Maybe calling the same people. No one's ever called me. I can't wait for the day to get a vaccine and for a rationalization to come back in this world. And I think that's most people. And I think what you said there, this tees up for a good economic environment, which really leads into the consumer. Everyone remembers the consumer is 70% of the economy. And the current conditions, the oranges or the green line obviously came crashing down with the pandemic. We've come back up, and we've actually had the numbers come out yesterday, and these turned back up a little bit, so roughly around 90, so just up a little bit. Overall, the fact that you think about this, through a pandemic, we've crashed and we've come up steadily from there. If you look at where we've been over this time frame, we're actually not bad compared to where one may imagine we would be.
You gotta say, the glass is half full, Charlie.
Yes. It is half full, but it could definitely be a lot worse, and I think people have adjusted fairly well. And if there's ever an okay time for a pandemic, I guess it's when we have good high-speed internet access at home.
Right.
So the consumers are also doing other things, and people ask us all the time, hey, what should I be doing to grow loans? Because obviously deposits are pouring in like water into a lake. There are things that people are doing, and these are areas to lend, and maybe it might take some different mindset of thinking about lending in different areas. Boat sales, obviously one of the important bellwethers of this world. What we're seeing here is that boat sales are up substantially. We're seeing people spending a lot of time getting into their hobbies. Florida, up 8%, Texas, 9%. Here we're in Michigan. Who knew we were the third largest boating sales state? $1 billion, up 10%, 9%, 6%. Boat sales are going through the roof, and we're seeing prices go up. So this is actually a really interesting area for me if I was lending to carefully do it, obviously, but a good opportunity. So the consumer is really trading, maybe not going on a trip to Disney World again, to go back to that statement, but instead they want to go for a boat ride. Mm-hmm. Now, what's also interesting, and I want to thank Craig for giving me this picture of him hanging out in the RV. RV sales are skyrocketing. It depends on where you look. There's a lot of different places. This was from Barron's. They're saying 19.5% up in 2020. I have other people telling me it was closer to 40%. Hard to pinpoint this number, so please don't hold this number to us. But what I can tell you is a significant increase in RV sales and shortages in RVs. Why? It's the safe vacation. Your pod is going on a vacation together and more family time, as we've talked about.
Yeah, and this, the previous screen on the boats, the RV screen, as well as a lot of other type of discretionary assets that people can purchase are really having an effect on collateral values. Yeah. I mean, new versus used, there's a real big tightening there where used vehicle sales or values and boat values and RV values are really high right now. So you got to be careful about that as you're going into that lending market.
New market, you always want to get help and learn from others that have been in it, but it's some great opportunity. And I think the most important opportunity is snowshoes. One should get into snowshoe manufacturing. Snowshoe sales have increased by 273% this season. I know that as I went to actually buy a pair of snowshoes, and it was limited to one pair that was left. Amazingly interesting to me that people are finding time now to do outdoor activities that they may not have been able to do because of commute, because of travel, because of a lot of reasons, and more people moving to rural areas and cities, they're finding things to do. So to me, this really shows that there is good growth in some areas of the economy. We really need to think about how do we get in those areas where we're going to have this growth to be able to lend. Who would think that lending to people that are businesses that are into snow sports would be a positive thing, but it is today, along with all sorts of recreational activities. And we could put bike sales on here. Bike sales hit record highs this year, too.
Right on.
Now, what else has changed in this pandemic? Obviously, snowshoes and boat sales and RV sales and car sales. We're also seeing something amazing happen to branches. Now, for the past, I'd say 10 years, we've seen bank branches reduce the number of branches. Credit unions have been going an upward swing in the number of branches until this last year. We actually saw credit union branches decline in 2019 and decline in 2020. And what we're seeing here, and this is a snip from the Federal Reserve Economic Data site, we've gone from a high point of having 36 branches per 100,000 people down to 31 branches per 100,000 people here since 2009. And obviously great to get a good headline when you're trying to prove a point. Yesterday in the news, Huntington Bank announced it's closing 198, so call it 200 branches, and they're closing 98 branches in Meijer stores. So they're going to close 200 branches as an orderly course of business. And I think this is a good thing for everyone to think about. What is the best structure that you have going forward, and why is this in an economic presentation? Well, there's some profitability points we want to make here today, but it also is the shifting activities of the consumer. I have not been in a bank or credit union branch since probably February, March of 2019. I found there's no need to go if I can use online services, bill pay on my cell phone, take a picture of a check. Maybe I've been to an ATM quarterly. It's really changed utilization of branches, and I think it's important for us to really think about this and take a holistic approach. Not right for everyone to close 200 branches or 10 branches or a branch, but it should be on the table to think about how consumers have changed.
Yeah, good point. And I just go down to call centers, and having have technology to be able to route, and maybe not the people in the call center, but the call center activity of repurposing people. Because we always want to remember, if we're going to look to see, hey, we can function differently with less branches, what do we do with our people? Well, we can repurpose. They have that same skill set, but to be an online customer service rep or teller or call center and have things routed to homes as well. So it doesn't necessarily mean that it's a reduction of headcount, right, but it is from fixed assets perspective and expenses for running them.
Yep, definitely a lot of expense cutting possible here. And efficiency. Efficiency ratio, especially with margins, which we'll talk about in a minute, tightening, it's a good thing to talk about. Now, the consumer, while they're also spending money on snowshoes and RVs and different things and not going in branches, they're not delinquent on loans. Now, when we look at student loans, obviously a very unique spot there with student loans not being, required to do things. You're not required to make payments right now. We're seeing also a potential $10,000 per student payoff of student loans by the federal government's getting floated. But we're also seeing delinquency at record low levels on different things. Now, car loans are coming back down. They've popped up a little bit here. But the reason why this is all happening, it's called cash. And this graph, as I just saw a note fly across, the Biden administration is looking to GameStop stock or GameShare stock as part of the Reddit stuff. It's entertaining, but they should look at their own graphs. And what they've done now, and not just them, but the last administration also, has pumped cash into this market to help offset the negative activities here. What we've seen is massive amount of cash growth, M2 money supply. We've gone 5 years worth of growth in money supply in the past 9 months. So massive amounts of cash. People have been given cash, lots of cash running around, which is resulting in amazing amounts of liquidity and therefore a lack of delinquency. And we're seeing people pay down debt today. But just amazing here what's happened. This graph is the biggest reason why the stock market is rallying as much as it is and why we expect it'll continue moving up over a period of time. The end result with all that cash, income, a little bit less spending, we're seeing here that Americans on average have the best ability to cover their debts since about 1997. People have a lot of cash, and also the cost of debt has declined, as we've talked about. A 2.6% 30-year mortgage gives people a lot of ability to buy things and a lot of ability to have free cash flow.
Yeah, and it's really interesting to look at this chart, that red dotted line being the household debt number, just under $16.5 trillion. So we haven't seen that it's really necessarily come down to cause this effect. It's more of what you had mentioned, Charlie, is the affordable debt, the low rate environment, the debt service payments being lower, along with some moderate or low to moderate increase in income, causing that disposable income to skyrocket up.
Yep, it's making people doing really good. Just a quick thing here. The economy is going well, if anyone has any questions. And the reason that I look at this, my backup test always is the price of crude. Crude's going up because of supply and demand. There's more demand. Maybe supply's cut a little bit, but there's more demand here at $45, $50 a barrel, not a bad spot, $52 a barrel. But we're also seeing rebounding rates. This is the price per mile to have a truck drive stuff around this country. We were in the 180 range, went down to 160, now back up to $2.22. There's a lot of activity at ports. There's a lot of things coming around, which is causing some backups and increase in costs here. And there is some coronavirus component to this with restrictions, but we are seeing some positive activity with freight and where things are going.
Yeah. I don't know if it's still the case, but I did know back in 2020 there was a shortage of drivers in that job market. So if you have friends looking for a job.
Yeah, absolutely. And there's also electronic modification, the logs and all sorts of changes. So that's an industry that's been in flux. Absolutely. So when predicting interest rates and talking about interest rates today, I want to start with inflation. I get asked this question daily, when's inflation going to spike, what's going to happen? Well, to start off with, inflation still is at extremely low levels. 1.3 in the PCE, 1.6 in the Consumer Price Index, ex food and energy, and 1.4 overall. Very, very low level of inflation. Why? There's a lot of different components to this. I'm nervous about inflation someday. Oh, absolutely. I think it'd be foolish not to be worried about inflation someday. But when buying goods off the internet, it's extremely easy to compare prices. Much easier to compare prices than ever before. So the consumer has bigger tools than they've ever had. And at the same time, the Fed is also going to be very accommodative of where we are with interest rates. So inflation isn't an issue yet, but at some point we're going to see that inflation may come to a head on that. But Craig, what are your thoughts on this?
Well, I think it's absolutely a fascinating topic to talk about, because we all know we've experienced inflation, and big inflation in certain pockets. And let's just go back to that housing market. It's expensive to build a house right now. And you factor in the cost of lumber, the inflation on that, the gypsum, the nails. We've seen in certain areas a lot of inflation take place. But overall core basket of goods, it's going to be moderate inflation for quite some time. One of the things that we saw over the end of last year of 2020 and first part of January this year was the stimulus programs and the amount of money that they're looking to put into the marketplace, which is causing people to be fearful of inflation. Now, it's since been coming down a little bit, but you got to understand and really think about where that money's going and what those expenditures will be with that stimulus money. So we're not overly concerned about even more stimulus coming to cause inflation. We think it's going to be very well moderated for quite some time now.
And I think it's a very good point. And thinking about this, where we are with yields, 10-year Treasury, we were down as low as 60 basis points, and we're now up to a 105. We're still well below where we were in December of 2012. Even though we've come back up quite a bit, 50 or something, 50, 60% increase in yield, still extremely low, and we're hanging around that 1% rate. It is a flat yield curve. You'll tell me it's steep all day long. It's still, you do get more yield for buying things out a little farther. But where we are today is we're in I say a good spot for yields, but definitely still low. So now this is a graph of the 10-year Treasury, and the 10-year Treasury is as I said, has come up a bit, but we're still very low, and we expect that this trend that's been going on, actually, we can take this chart all the way back to the 80s. We've been in this constant decline in yields in the 80s to today.
Right. So, and just remember, it's going to be some jaggedness to it, but it's like steering a large ship where it's going to be a slow, steady turn on the curve in interest rates. And so don't expect rates to go popping super high anytime soon, as you can see.
We still have our wonderful chart here where we compared all these other countries. And while the U.S. has ticked up a little bit, we haven't seen much of a change in Japan and Germany and the United Kingdom. We'll see what happens. Japan's a little bit up. It's positive now, which is kind of fun. But we'll see what happens. But we would expect that the United States would be the leader in economic activity and the first one to come up a little bit. So not surprising, we're coming up a little bit, but I'm not seeing any big changes either with you. And going to one of our favorite graphs, where we stand here, I think the real point I want to get from here today is we were in this low interest rate environment, as actually, Craig, you predicted correctly back in 2009 for 10 years. And, I think we're looking, as we've predicted, 5 years at the onset of this, so another 4 years. It's really easy for the years to go on and interest rates to remain low, because it does take a lot of time to create inflation in a broad-based economic viewpoint. Might be some spots in housing with lumber prices, it might be a couple spots, but overall the entire inflation of the economy does take a while to get there. So we're not concerned about it today. We think the market is the interest rates are acting fairly normally as we'd expect at this point. Picture the Fed funds rate, we'll skip that. And here the target rate of the Fed funds is going to continue to be at 0 to 25 is my expectation from the Fed meeting. And the thing to note here is the implied rate is about 5 or 6 basis points, meaning cash yields are going to continue for the next year. At least this is showing through January of 22 at 5 to 6 basis points, which really gives good credence to why it makes sense to invest and not sit on large amounts of cash today.
Right, and that's going to be a continued theme for quite some time. Just got to kind of think about how to manage that balance sheet. So from here, interest rates are low. They're going to be low for a long time. We're finding great things to buy every day. And as cash stays at 5 basis points, we really should invest. So anything else from an interest rate viewpoint that everyone should be aware of, or sticking with basically where we are with interest rates for the next 12 months? Same prediction for the next 12 months on interest rates. Maximize your cash. There is a big difference, or I should say there's a large sampling of people on today's call today, some that are involved in, say, PPP lending, some that are not. There will be some specific situations where you're going to have some cash and liquidity that are going to fluctuate. But overall, we think you've got to continue to maximize your earning assets, utilize your cash to your best ability to help offset declining margins.
It's a really good point, and I appreciate you saying that, declining margins, because the result of everything we've talked about today is declining margins. And looking at where we are here with margins, and this is FDIC data, the red line is banks over $1 billion, the blue line is banks less than $1 billion. And what this is showing is that larger institutions are taking in a significantly amount more of deposits, and they're deploying those in investments. And they're really seeing their margins shrink substantially as, again, more and more cash is coming in. They're putting more investments on their books, and their loan-to-deposit ratio is dropping like a rock. Community banks and credit unions have done a much better job of keeping loans higher, although I would expect that almost everyone in this call is seeing a lower loan-to-deposit ratio, and that's okay. It's hard to lend in a pandemic. We really have to rethink lending, and that goes back to the slides we went through earlier. We've got to rethink what is going to survive and not survive, because it may be surprising. Resort areas that people can drive to are doing really well. Lending in that type of market to those types of businesses can be very lucrative today, where other people may have just stopped all types of lending. So really focusing on this, because this is going to be the biggest challenge of our industry, is the margin and where we go with this margin. And seeing here, sub 3% margins is just a horrible number to survive long-term, especially for a community bank or a community credit union. Very, very difficult, but we do expect there's going to be good opportunities in some investments and good opportunities in some loans to continue to keep our margin at reasonable levels. Now, as we started off this presentation talking about the dichotomy in the two different groups of people in the country, effectively people that can work remote and people that can't, that are unemployed, we're seeing that there's two levels of profitability that we see. And, some institutions are doing well and some are doing not as well. And we think about this for everyone to really focus on base profitability, which is lower deposit rates as much as possible, really focus on that. Why people are saving because they have extra cash, they're not saving because of a rate today. Hold steady on loan rates the best you can. Obviously, you need to be competitive and get them on the books, but we are seeing that people still have risk, and making sure you're looking at that risk appropriately and being compensated appropriately. One of the things it's tied in with profitability is also focusing on capital ratios. I've had more conversations about ROE and capital to asset and asset growth. As people see these massive amounts of growth, you're having positive earnings, but capital ratios are going down because of that large growth. Monitoring that and being prepared to work on that. Fully investing funds, as I mentioned earlier, 1% is better than 5%, right thing to do. And again, reduction of the loan-to-deposit ratio is okay. So these are all things that are okay. And I think, if anything, ALM is key today. Asset liability management is key. And planning and making sure you're thinking about new products and what new products you're getting on there are extremely important. And so for everyone, this base level of profitability is in place and needs to be there. Now, to get in the top quartile of profitability, and where we're seeing that dichotomy, as I mentioned, people that have sources of non-interest income are doing substantially better than those that don't. So I highly recommend, if you don't have a good stream of non-interest income, to really, even today, where you may think mortgage days are gone, they're not gone. We're going to continue to see people moving. 25% of America does not want to live in their house for over 20 years. It's probably closer to 10%. So we're going to see movement. We're going to see new mortgages. Great profitability gain on sale. PPP version 2.0 is coming fast. It's not going to be as big as version 1, but the fees are there, and we're going to continue to see people get fees from PPP version 1 and now PPP version 2. Don't forget the SBA. The SBA does other types of lending and utilization. And one thing when we tend to see coming out of an economic problem and with a little bit of a shift to more of a Democrat side of control, you tend to see more programs to help people go through government activities. We'd expect government programs to grow, and this may be one, which is a good opportunity to make some fees from gain on sale.
And there'll be some stressed businesses out there that, will maybe all of a sudden fall off the ability for traditional lending. And so being able to have that product available to them would be great. I also wanted to just comment on the mortgages as well. You're right, it's not the end. Even though we had mortgage rates that might tick up a little bit, they're not going anywhere. But we have seen a distinctive shift of the percentage of mortgages being written of refis versus purchases. That refi business has come down, but the market is still very viable to make a lot of income for your institution.
Yeah, definitely. It's still there. We started off one of the graphs showing 170% increase in quarter 1, it's supposed to be in quarter 2 of 2020, brokerage accounts. The old-fashioned broker in the lobby is still a great spot to be, and that's something we'd highly recommend, that you look carefully at the broker in the lobby model or brokerage activities. More and more people, millennials especially, have adopted investing in savings much more than older generations, and this is something I think they're doing it earlier and faster, and something you could really do well at.
Right, and making sure you work with those brokers, because they need to go after our customers, your customers, slightly different than they have over the last 5 years with the amount of liquidity out there and the type of products. One is the discount brokerage, but then also you look at, oh, there it is, some insurance sales. They can do those, annuities, insurance products that people have all that liquidity. They're looking for something to put that into.
Yeah. And we know more and more, because of the types of loans we have, because the servicing of loans, MSRs, you know what people's insurance is, and car loans and home loans. You've got the ability to actually offer them a better product at a cheaper price too, which is truly what the community bank, community credit union world is all about. So I'm really excited about that opportunity. And then the top quartile performers, I will say, are taking some very serious looks at their branches. We're seeing people cut branches, close branches, shrink hours, do all sorts of different things today, and really looking at how consumers have changed. Read an article the other day that stated the last 9 months have been effectively 10 years worth of change in the retail industry. And that doesn't surprise me. I don't know if it's quite that big, but it's a lot has changed in a very short period of time. So with that, a couple projections to wrap stuff up on here today. Margin compression is going to continue. And that's why making sure we're looking at these non-interest income activities and operational cost activities is extremely important. Delinquency and losses are going to be back to normal. We don't see higher than normal, probably not lower than normal, as we're going to see some businesses such as restaurants fail. Even here in the state of Michigan, they've decided to open up 25% capacity. Most restaurants lose money at 25% capacity, so we'll probably continue to see more restaurant failures as other states also impose different activities. So it won't be on everyone. A lot of people are doing well still, and that they won't have losses, but we're going to see that continue. Earnings without non-interest income. If you're not one of the institutions that has a good non-interest income stream, you're going to continue to see tougher days with the margin compression. Loan to deposit ratios are going to decline. It's going to continue on a go-forward basis, unfortunately. That's just because of the total amount of stimulus. Read a news article this morning, the amount of stimulus proposed in Biden's plan this week was more than the 1981 entire government budget. So we're seeing a ton of more stimulus coming, which is only going to have cash come in the door, which will result in capital ratios being stressed. So a lot of that's going to continue down this path. And again, I think, Craig, the most boring statement but truest statement is low interest rates. Real simple.
Simple. Correct.
So remember, reassure everyone, this is definitely a scary time, and it's going to continue to be a scary time. Death numbers are high, infected numbers are high, people in school, not in school. Make sure that you're there and out in front talking with people. It's the best thing to do to make sure everyone's doing okay. Make sure you're planning your balance sheet with asset liability management. You're thinking about the products you're going to use, and make sure you're fully invested. Interest rates are going to continue to be low. Cash is going to continue to be there. Please work with your advisor here to ensure that you're fully invested and the portfolio is being designed correctly. It will take a long time for this money to go out. Not everyone's going to go buy snowshoes and boats on, May 1st. It's going to take years to go back out if it does. If we look at the deposit increase we had back in 2008 and 9, it never went away. Now, do I think some of this will go away? It might, but I think we need to plan on it sticking around for quite some time. And where capital ratios are, pennies are making differences. A couple additional 30, 40 basis points on investments is making a big difference today. And focus on other source of income. Make sure you're getting out there and getting into other activities if you're not in them today. Credit union space, alternative portfolios is a great area to get additional earnings, but for everyone, such as mortgage and sales and SBA sales and insurance sales are all great areas to help grow revenue. And with that, the last but not least comment here is CECL is coming. It's not getting delayed much. It's been delayed a year, but we do still see CECL coming, and making sure you're hopping on board and doing some planning on CECL is going to be extremely important to ensure that you have some time to compare and look at the effects of what has happened. So with that pause, Greg, you've given us some great insight on interest rates. I know we had a Fed meeting today, and I'm going to answer a quick question, and then I want to come back to you and have you give us a little insight of whatever the Fed said today in their comments. And a question that did come in was, what's my viewpoint on booking mortgages versus selling them? And it's a great question, and why it's really a great question is it really depends on your balance sheet. I don't like the idea of putting 3% mortgages on the books for 30 years. If 5% of your balance sheet was that way, or 7 or 8 or 9%, that's not a big deal. If it gets much bigger, I start to get nervous. Obviously, it's unique to your interest rate risk position. But it is nice to get that one-time gain on sale to help boost capital today. And so I'm leaning more towards selling for the viewpoint of boosting capital and continue to do more mortgages and boost capital versus put it on the books at this point. Again, a little bit of everything's okay, so it's not a one-off size only. So with that, Craig, I do want to ask anything from the Fed meeting today that's worthy to bring up to talk about with the group here.
Yeah, thank you for asking. The language that came out was as expected, but I just wanted to talk a little bit about just a couple of bullet points that was in there from Powell, and he is talking right now as well. But they're going to continue on with their asset purchase program. It's approximately $120 billion a month is what the balance sheet is buying right now. They do not have any plan on changing that right now. And they want to get to, as we talked about in our release at 2 o'clock, was a full employment as well as a sustained 2% inflationary rate, neither of which we're at right now. The other thing to talk about is what would the Fed do first? Would they start changing their balance sheet, or would they change interest rates? And it's important to talk about it in this meeting because we need to know where interest rates are going to be to help manage what we're going to put on our balance sheets. And before they do any kind of change to the direction of their overnight lending rates, they're going to change their purchasing program. I don't think it'll be at the same time in unison or in step, but they'll first start to taper off their purchase program. And what someone would naturally think it could potentially put more of those assets within the market, causing a slight little uptick in the longer end of the curve. And I don't mean they're going to go materially different. And then they would consider doing a change in their interest rate policy. But we don't see that happening. And they did say that they're standing pat. They did also mention that they also do see a slight moderation of the economy right now. We are seeing a mixed bag of things, some positive things in the housing market, but we're seeing some negative signs as well. So then they're aware of that. And they're also aware of government stimulus, although it's good to help boost up or maintain economic growth and uncertainty, it can't be sustained. And so you need to have a self-sustaining economy, which we do not have without having the government intervention, and they're aware of that. So once again, loud and clear, interest rates aren't going to change for the foreseeable future.
No, appreciate that, Craig, and that's, I think, a good thing for us to take into account, that we need to live with this environment, and that's those activities we've talked about today for profitability is extremely important.
Right.
I'm going to have a couple more questions here, and then we're going to wrap up the call. Question was asked, when is CECL's date, after my comment about CECL. So CECL's implementation date is January 1 of 23, which means that on January 1 of 22, you really want to be running a parallel model there and good to go. And we're encouraging people to sign up now and start working with CECL, because it takes a while to make sure that the data is right. This is a pooling argument process that needs to take place in a data retention. And so starting off now is something I'd highly recommend everyone to do. So no matter what, you have at least a full year of activity. Originally, they were talking about 5 years of data, and so it's getting down to the point where it really needs to be done to at least get that data correctly put together. A couple other questions that came in. One was actually data that unemployment is taxable. I appreciate the note sent there for everyone. So unemployment income is taxable. From there, another question that came in, any comments on credit union merger activities? And I think it's a good question on overall merger activities in the bank and credit union space. What we are seeing is a lot of conversations. There's still concerns over credit, but we do think here as margins get tighter, you get greater efficiencies with larger institutions. And so paying attention to the efficiency ratio and expenses, it's a bit easier with a larger institution to survive those things. So I do expect we'll see some more activity here. And with that, the last question we'll have today is many credit unions are extending, and banks are extending loan terms due to the difficult situation they're in. Are we seeing problem with the collectability of those deferred loans? And the answer is if we look back, history will tell us as long as the process of requiring those dollars to come back are not all immediate, such as some deferral programs say you can defer loan payments for a year, but then all those historical year payments are due on one day, you're setting people up to fail. If you're able to rewrite the loans, do things different, to extend out those payments so people are going back to their normal payments and maybe adding 6, 8, 10, 12 payments on the end of the loan and extending the term, we see those as much more successful on a go-forward basis. So with that, I do want to thank everyone for joining us today. We appreciate the relationship with you and many of you for a great number of years, and we're always here to help. And if you have any questions, please feel free to reach out to your advisor. With that, we're excited. We do have a couple more webinars coming up here in the next couple months. We're going to be diving into some activities, talking about alternative investments, and a couple other great topics. So please check the messages from your advisor. So with that, thank you all. Have a wonderful day. Thank you, Craig, for your insight and help today and your predictions on the interest rates, which have been spot on here for the past 15, 20 years.
You're very welcome. And to our listening audience, if you've heard something or have a follow-up question on anything we talked about, capital is a great question. We talk about that, of how to resolve or issue or anything of that nature. Please don't hesitate to reach out to your advisor or Charlie or I, and we can walk you through anything that concerns or questions that you have.
Thank you all very much. Have a wonderful day.